Most people think $10,000 isn't enough to make a real difference, but think again. The truth is, it's not about how much you start with, it's about where you put it. Today, I'm going to show you a list of ETFs that can change your mind. In this video, I'll break down 5 of the best ETFs for investment growth and income. I'll show you and John how much you can earn from each of these ETFs. In the end, I'll show you one of my favorite ETFs that has the potential to turn $10,000 into over $1.5 million while paying over $20,000 in monthly dividend income. So let's do it. Let's jump straight into the top 5 ETFs. Remember, each ETF is better than the last, adds more value to the portfolio, and ultimately increases dividends, leading to our number 1 pick with the best growth and dividend. Starting at number 5, we have Invesco Bloomberg MVP Multi-Factor ETF with the ticker symbol BMVP. This ETF combines the best of multiple investment strategies into one package. It uses a multi-factor approach, selecting stocks based on value, quality, momentum, and low volatility. Multi-factor investing has gained popularity because it avoids relying on a single market factor to drive returns. Instead, ETFs like BMVP spread their bets across several criteria that historically outperform. By leveraging Bloomberg's proprietary factor models, this ETF is finely tuned to adapt to market trends, selecting companies poised to excel in different economic environments. What really sets BMVP apart is its adaptability. Markets are constantly changing, and sticking to just one strategy, like focusing only on value or momentum, can leave you behind when trends shift. BMVP's multi-factor strategy dynamically adjusts its holdings to seize the best opportunities. This creates a balanced mix of growth, income, and risk management, keeping your portfolio prepared for different economic environments. When it comes to income, BMVP's dividend yield of 1.56% might seem modest at first glance, but it's backed by a strong dividend growth rate of 13.81% and an average annual return of 6.67%. So this ETF is designed for dependable long-term growth. Starting with an investment of $10,000, the growth potential of BMVP over time is impressive. In the first year, the portfolio value will grow to $10,823. By the 10-year mark, the investment will have doubled, reaching $23,326. In 20 years, the portfolio will reach $66,178. Looking ahead to 30 years, the portfolio value will be an impressive $274,221, paying $26,743 in annual dividends, or about $2,229 in monthly dividend income. The total value gained after 30 years will be $264,221. Of this total, $122,264 will come from capital appreciation, while $141,957 will be generated through reinvested dividends. Up next, at number 4, we have an ETF that has a more focused and fundamental approach to value investing. Wisdom Tree U.S. Value Fund with the ticker symbol WTV. WTV is a standout ETF for those who believe in the timeless principles of identifying and capitalizing on undervalued opportunities. Focusing on U.S. companies with strong fundamentals that trade at attractive valuations, WTV aims to deliver outsized returns over time by targeting firms undervalued relative to their intrinsic worth. Unlike other value-focused funds, WTV takes a data-driven approach, screening companies for profitability, cash flow, and earnings quality to ensure only the most promising candidates make it into the portfolio. This disciplined strategy captures the essence of value investing while steering clear of common pitfalls such as value traps or stocks that appear cheap but lack growth potential. What makes WTV unique is its focus on both value and growth. While investing in undervalued stocks, it prioritizes those with solid fundamentals and strong future earnings prospects. This combination makes it a standout among traditional value ETFs. With a 1.56% dividend yield and a 13.64% dividend growth rate, WTV attracts investors seeking growing income alongside capital appreciation, which averages 9.93% annually. For John, starting with $10,000 in this ETF, the first year will see his portfolio grow to $11,149. By the 10-year mark, it'll reach $30,448, more than tripling the initial investment. In 20 years, the portfolio value will reach $99,665. By the 30th year, John's portfolio will reach an impressive $361,727, providing $14,185 in annual dividends. That's $1,182 per month. The total value added to John's portfolio will be $351,727. Of this total, $93,226 will come from reinvested dividends, and $258,502 will come from capital appreciation, resulting in a total value gain of $351,727. So these are good returns, but there are even better ETFs to come. In the end, I'll show you one of my favorite ETFs that has the potential to turn $10,000 into over $1.5 million, while paying over $20,000 in monthly dividend income. Okay, let's get back to our list with the third ETF, the Schwab US Dividend Equity ETF with the ticker symbol SCHD. SCHD is a powerhouse for anyone looking to combine consistent income with steady capital growth. This ETF focuses on high-quality U.S. companies that have a proven track record of paying and growing dividends. With a design built for stability and income, SCHD has become a favorite among dividend investors who want reliable long-term returns. What makes SCHD stand out is its disciplined stock selection process. It tracks the Dow Jones U.S. Dividend 100 Index, which carefully screens companies for more than just dividend yield. It also looks at financial health, earnings consistency, and return on equity, ensuring that the fund includes companies capable of sustaining and growing their payouts over time. SCHD shines as one of the top dividend ETFs because of its strong combination of income generation and capital appreciation. With a dividend yield of 3.61%, it provides immediate income, and its 11.04% dividend growth rate ensures that this income grows significantly year after year. Unlike some other dividend-focused ETFs, SCHD avoids chasing the highest yields, which can sometimes lead to riskier investments. Instead, it focuses on quality and financial strength, making it a dependable choice for beginners and experienced investors alike. Its average annual return of 7.41% makes it a great option for those with long-term financial goals. Now, let's talk numbers with SCHD. Starting with $10,000, SCHD delivers noticeable results quickly. In the first year, the portfolio will grow to $11,102. By the 10-year mark, it'll climb to $30,155. In 20 years, John's portfolio will be valued at $106,927. By year 30, SCHD's consistent focus on income and growth produces remarkable results, with the portfolio reaching $475,775. The annual dividends at this point total $41,088. That's $3,424 per month. Of this impressive growth, $220,035 comes from capital appreciation, while $245,740 comes from reinvested dividends. Altogether, SCHD turns John's initial $10,000 into a total value gain of $465,775, proving it's a smart choice for building dependable income and wealth over time. The number 2 ETF on today's list is the ProShares Ultra Dow 30 with the ticker symbol DDM. a leveraged ETF designed to amplify the daily performance of the Dow Jones Industrial Average, DDM aims to deliver twice the daily return of the Dow, making it a high-powered option for investors looking to supercharge their growth. So what sets DDM apart? The Dow Jones Industrial Average is made up of 30 large-cap U.S. companies, including familiar names like Apple, Boeing, and Coca-Cola. By leveraging the daily returns of this index, DDM gives you enhanced exposure to these market leaders. It's a great choice for investors who trust in the strength of these companies and the stability of the U.S. market as a whole. Even though it's a leveraged ETF, DDM has a relatively low expense ratio compared to similar funds, meaning more of your money stays invested working for you. Plus, while leveraged ETFs are often seen as short-term trading tools, DDM's consistent performance and dividend reinvestment options make it a solid candidate for long-term investing as well. Let's talk about how DDM balances growth with income. Leveraged ETFs are typically known for dividends, but DDM's 0.99% dividend yield provides a modest and steady income stream. The real magic, though, is in its impressive dividend growth rate of 21.43%, which shows how quickly those dividend payouts grow over time. Combined with an average annual return of 16.13%, DDM becomes a powerful tool for building both wealth and a growing income stream. Here's how it could play out if you and John invest $10,000. In the first year, your investment will grow to $11,712. By the 10-year mark, your portfolio will reach $49,706, already a massive jump. After 20 years, your investment soars to $265,629, over 26 times your original amount. By year 30, DDM's growth is truly staggering, with your portfolio hitting $1,600,853. At that point, you'd be earning $58,779 annually in dividends, nearly $5,000 per month. This growth is driven by $1,306,230 in capital appreciation and $284,623 from reinvested dividends, making the total value added to your original investment $1,590,853. Finally, taking the number one spot on our list is Wisdom Tree Japan Hedged Small Cap Equity Fund, with the ticker symbol DXJS. So when you think about investing in ETFs, Japan's small cap market might not immediately come to mind, but this fund is a hidden gem offering unique opportunities for both income and capital appreciation that many investors tend to overlook. If you're looking to make the most out of a $10,000 investment, this ETF deserves your attention. What makes DXJS unique is its focus on Japanese small-cap companies, which are often overlooked in favor of large-cap or mid-cap counterparts. But small-cap firms are the engine of innovation in Japan. These companies often specialize in niche markets, excelling in areas such as advanced manufacturing, technology, and robotics. These businesses are agile, adaptive, and capable of exponential growth. By investing in this ETF, you get front-row access to the incredible potential of these rising stars. Another key feature of DXJS is its currency hedging strategy. See, one of the risks of international investing is currency fluctuations, and the yen's volatility can impact returns, even when the underlying stocks perform well. DXJS removes this concern by hedging against currency movements, ensuring that your returns come purely from the performance of the companies themselves, not the ups and downs of exchange rates. So now let's talk about what this ETF could do for you and John. Starting with $10,000, the journey begins slowly, with the portfolio growing to $11,258 in the first year. By the 10-year mark, the momentum starts to build, and the portfolio value will reach $36,346. Fast forward to 20 years, and the portfolio will be valued at $183,998. Now by year 30, the initial $10,000 will be valued at $1,613,290. What really sets DXJS apart is its income-generating potential. By the 30th year, annual dividends total an incredible $249,869. That equates to about $20,822 in monthly dividend income. The total value added to John's portfolio will be $1,603,290, with $559,894 coming from capital appreciation and $1,043,396 from reinvested dividends. Want to know how to turn a $30 weekly investment into a portfolio that pays over $5,000 in monthly income? Click the video on the screen.